Before we begin this week's episode of the Grow Your Wealthy Mindset podcast, I want to tell you of a great guide that I made just for you. It's the 12 financial mistakes that keep physicians from building wealth. After talking to hundreds of physicians, I've heard many mistakes, and these are the ones that I thought were most important to share so that you can potentially avoid making these mistakes, or if you've already made them, learn a bit about how you might be able to recover. You can grab the guide at my website, www.growyourwealthymindset.com/12 financial mistakes. Now on to this week's episode. Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Zhang. Hello, and thanks for joining me on the Grow Your Wealthy Mindset podcast. For today's podcast episode, I thought I'd talk about stock options. While I don't suggest physicians take the time to learn and engage in options trading, I still think it's a good idea to understand what options are and what is meant by trading in derivatives. An option, by definition, is a financial instrument that gives the owner the right, but not the obligation, to purchase a specific asset at an agreed-upon price and date. In that light, when you have a stock option, this allows the owner to purchase a specific stock at an agreed-upon price and date. A stock option is a type of equity derivative, which is a financial instrument whose value comes from price movements of the underlying asset. If you remember back to calculus, when you learned how to take a derivative, what you were doing when you took a derivative of an equation was measuring the change in rate. An equity derivative is based on the change in rate or value of the asset. There are two types of options that trade on the stock market: calls and puts. A call option allows the owner the ability to buy the stock at a stated price within a specific time frame at some point in the future. When someone buys a call option, they're essentially betting that the stock price will go up or rise. Puts are the opposite of calls. It allows the owner the right, but not the obligation, to sell the stock at the stated price within a specific time frame. Puts are a bet that the stock price will fall. Employee stock options can be used as compensation for employees of publicly traded companies or even some private companies. This is often used to incentivize executives or even regular employees to grow the value of the stock price of the company so that their option becomes more valuable. Let's say a high-up executive is hired to work at Google, where the price of a share of stock is $174. They may have in their contract the option to buy a certain number of Google shares a year from the time they're hired at, let's say, $180. If they can get the price of a share of Google stock to rise to $200 a share, then they would be able to make $20 a share, essentially risk-free, by exercising the option, buying the stock at $180, and immediately selling it on the open market for $200 per share. However, if the value of Google's share price doesn't change over the course of the year, then they don't lose money because they don't have to exercise the option and buy the stock at the higher price of $180. This incentivizes and rewards the executive to grow the company's value over the course of the year so that the value of the stock increase above the amount of the option allows them to buy the stock at a discount to how much it's being sold on the open market. Often, if stock options are part of the compensation package, you won't receive the options immediately. There is typically a vesting period until you are able to exercise the option. There may also be an amount of time that you must work for the company before you may receive your shares as well. Options can be purchased on individual stocks as well as ETFs, exchange-traded funds. Traders can use equity options to take a short or long position in a stock or segment of the market through an ETF without actually buying or shorting the stock. The advantage of this is buying an option requires less capital than buying the shares of stock outright. It essentially allows the trader to use leverage to benefit from the price movement of a particular stock. Each option will have a strike price, which is the price the holder of the option is entitled to buy or sell the stock for which they hold the option. Options will have a set date or time frame from which they could be exercised. An option will have an expiration date after which the option is no longer valid. Typically, options with longer expiration dates will be worth more since that gives more time for the stock to move in the way that benefits the option holder. An option may have an expiration date of a week after it's purchased or a year after it's purchased. The contract size specifies the number of underlying shares that the trader is able to buy or sell with the option. One contract is equal to 100 shares of the underlying stock. The premium is the price paid for the option. Let's go over an example. Let's say a trader thinks Amazon share prices are going to keep increasing and go up. The share price is currently at $205. The trader may buy a call option that allows them to purchase shares of Amazon at $230, which expires 3 months later, let's say on November 1st, which is about 3 months after this podcast episode will release. The $230 is the strike price, and November 1st is the expiration date. If the trader buys 5 November Amazon $230 calls for $1 per contract, the trader would spend $500 in premiums to purchase the option contracts. The trader then waits until November 1st. If on November 1st, shares of Amazon are now valued at $235, he can now exercise his option to buy 500 shares of Amazon at $230 and sell it on the open market at $235 so that he's making $5 a share minus the $1 premium he paid per share. That gives him a profit of $2,000 minus any other trading fees. The trader could potentially also just sell the call option itself to avoid having to buy the actual shares of stock and then immediately sell them. If the price of Amazon on November 1st, the expiration date, is less than $230, the strike price on his option, he does not have to actually exercise the option and can let it expire. He does lose the $500 he spent on the premium in order to buy the option. Now let's turn the example to a put option. Let's say the trader thinks Amazon share prices are going to drop within the next 3 months. The trader then buys a put option with the strike price of $180 that expires on November 1st. He buys 5 November Amazon $180 strike price puts for $1 per share and pays $500 in premiums. If the market price of Amazon decreased to $175, the trader can then buy 500 shares of Amazon at the market price of $175, then turn around and exercise his option, which allows him to sell the shares at the strike price of $180, making $5 per share or $2,500. His profit is $2,500 minus the $500 in premiums he paid and any trading costs. He could also sell that put option itself, which will be worth more than when he bought it because the strike price is above the market price. However, if the price of Amazon shares do not drop below the strike price of $180, then the trader would allow his option to expire worthless, and he would have lost the $500 he paid as a premium for the option. Buying options allows a trader to bet on the rise or fall of the value of any given stock by a specific date in the future. Previously, I briefly mentioned shorting a stock. Buying a put option is different than shorting a stock, but both are essentially betting that the stock price will go down. When you short a stock, you borrow shares of a stock from a broker and you sell those shares at the current market price. Then you wait and hope that the price drops. When the price of the stock does drop, you rebuy the shares and return it to the broker. This is much riskier than buying options because your potential loss is unlimited. If the stock price goes up instead of down, you may end up having to purchase the stock at a much higher price than you previously sold it in order to return the stock shares to the broker. You may also end up paying interest and possibly fees to borrow the shares. So why would someone short a stock instead of buying a put option? Put options have expiration dates, whereas shorting a stock remains open-ended. However, if the share price continues to rise, the broker may require more collateral to be deposited into your brokerage account in order to cover your losing investment. If you fail to do so, the broker may sell off positions you have in your brokerage account, potentially at a loss to you. The opposite of shorting a stock is buying on margin. This is done when someone thinks that the shares of stock will go up. You borrow money from your broker to buy shares of a stock for which you also pay interest and likely fees. If the value of the stock you bought on margin goes down, you'll need to deposit more cash. Failure to do so could cause your broker to sell off your stock, likely at a loss, to restore the margin ratio. Investors can use different strategies with options to generate income off the stocks that they already own. One such strategy is the covered call option strategy. In the case of a covered call, you need to own shares of a stock. This works best for a stock that you expect the stock price to either stay flat or to increase minimally over time. Let's say you own 1,000 shares of Starbucks stock, which is currently trading around $85. You could sell a call option against those shares that would allow someone to buy your shares for a specific price, the strike price, up until a future date, the expiration date. You collect a premium for selling the option. Let's say you sell a call option with a strike price of $100 that expires in a year for a premium of $2 per share for your 1,000 shares. If a year later, the stock value increases but is still under $100 a share, then the option would expire worthless to the person who bought it, and you would have made $2,000 off the premium. However, if the stock price rises to $110 a share, then the option buyer will exercise the option, and you'll end up selling your stock for $100 a share. You still made $2,000 from selling the premium, and you made money from selling your stock, but you no longer own the stock, and you sold it for less than its current market value. Essentially, you've capped your profit based on the strike price and the premium. If the stock price falls over the course of the year, you still have your $2,000 premium, your stock has lost value, but the downside is the same as owning the stock, and the premium gives you a small cushion against the loss. So if this is a stock that you wouldn't sell regardless of how much it goes down, you're at least still getting some money through the premium by selling this option. Covered calls are a way to generate income on stocks you already own and can be good when markets are fairly flat. However, it caps your upside since you give up potential profits if a stock soars in value. You're also still exposed to the downside of the stock losing value. Another option strategy, called the protective put, is like buying an insurance policy for your stock. This is for an investor who already owns a stock and wants to limit potential losses. Let's say you own 1,000 shares of Nike, which is currently trading at $60 a share. You're worried that the stock may go down in the short term, but you believe in the future of the company and you don't want to sell it. You could buy a put option with a strike price that's below the current stock price, say $50 a share, with an expiration date of 3 months. You pay a premium of $1 a share or $1,000 for the option. If the stock price drops to $40 per share, you can exercise your put and sell your shares at $50 a share, which is $10 higher than the market value. You end up losing $10 a share compared to the $60 a share that the stock was worth when you bought the put option, but that's better than losing $20 a share, which is the true market loss of your stock. You paid $1,000 for this premium, so basically you've paid $1,000 to lose $10,000 instead of $20,000. If the stock price rises, you don't exercise the put option and it expires worthless. You benefit from the rise in the share price, but lose the $1,000 that you paid for the premium. This strategy may be used when an earnings report is about to be released in order to manage the risk of a bad earnings report tanking the stock value. I'm also kind of pulling all these numbers for the cost of the options kind of out of a hat, just using easy numbers. So don't take the numbers I've been throwing out as indicative of what options actually cost. There are other strategies like the bull call spread and the bear put spread that involve buying and selling options which limit risks but also cap profits. With a bull call spread, you buy a call option at a lower strike price and sell a call option at a higher strike price. This has a lower cost than buying a call outright, but it also caps the profit. With the bear put spread, you buy a put at a higher strike price and sell a put at a lower strike price, which allows you to profit from the fall of the stock, but while also limiting the risk. There are other strategies that can be used with options. All these strategies are essentially trying to take advantage of the volatility of the market. I personally have not done any of these strategies myself. To me, it really feels a lot more like gambling. It also means sitting around and just watching stock activity, which you really have no control over. However, I hope this episode illustrated what is meant when people talk about options trading or derivative trading. It's amazing to think that there are thousands of people who sit around just trading options and essentially not creating any value for our economy other than playing on the volatility of our stock market. I hope you're having a wonderful summer, and thank you so much for being a listener of the Grow Your Wealthy Mindset podcast. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you. Don't forget to pick up your guide, 12 Financial Mistakes That Keep Physicians from Building Wealth. You can grab that guide at my website, www.growyourwealthymindset.com/12 financial mistakes. You'll also find that link in the show notes.